Hi taxpayers. Today we're going to talk about something that's really true and dear to my heart, and that's taxes. Specifically, what happens if you live in Indiana but you work in Kentucky? Now granted, this is probably a really small population, so if you live in, say, Kentucky but you work in Indiana, this video may not be extremely helpful. Likewise, if you live in Indiana but work in Ohio, or you live in Nevada but you work in California, this information that I'm about to go over will probably give you an idea of what to look out for, but you really need to make sure you read your state-specific tax implications because, again, this is really only for Indiana residents that work in Kentucky. Because depending on how things are set up, you could be ultimately screwing yourself financially. So let's take a look at what exactly is going on here. So if you get paid, you generally know what a W-2 is. You get a W-2 at the beginning of the year, which represents the money that you have earned that prior year. Now, there are certain things that you really want to look out for. At the bottom of your W-2, there should be a box 15 through 20. This is really important because this is your state and local tax situations, or tax withholdings and information regarding that. However, if you receive income that is not represented on a W-2, say Social Security or unemployment or gambling winnings, same situation, look at the bottom of that form and you should see something that represents some sort of state versus local tax withholdings. And that's what we're going to be focusing on. Now, what happens, again, you've got these cross-state situations going on. Well, depending on how things are laid out, is really going to depend on what we have to do next steps. So let's say hypothetically you get a W-2. In box 15 you have an IN, which stands for Indiana. Now again, you're an Indiana resident and you look at the bottom of your W-2 or whatever income form you have and you see Indiana. Perfect, that's exactly what we want to see. Now over here in box 17 is going to represent your state withholdings. Now what makes this interesting is because there are actually technically, I guess you want to say, three forms of withholdings when it comes to your income. There's the federal, which is what the IRS wants and looks at. There's your state, which is obviously your state. And then you have what's known as your county or local. So depending on where you live within your state, there may be different tax implications there. So for example, if you live in Indiana, you pay about 3.25% of every taxable dollar to the state of Indiana. I think it's 3.23 at the time of this recording. So again, Indiana, 3.23. Again, I may be a little off. However, depending on what county you live in, it could actually change. If you live in Clark County, it's 2%. If you live in Harrison County, it's 1%. So for example, if you live in Clark County, 3.25% roughly will go to your state. However, you're also obligated an additional 2% to Clark County, which all in all, about 5.25%. So, I digress. Going back to your W-2, you see an IN in box 15, and then you see a number in number box 17 that's on the same row as that IN. This again is going to represent the state tax withholding from your wages. Now that's really important because let's say this is $3,000. That means $3,000 was withheld from your income that was set aside to pay Indiana. Not Indiana County, just Indiana State. Again, remember, there's state and county. They're two separate. Now, what's nice is, again, if you're an Indiana resident and you have Indiana taxes taken out, then that's a dollar for dollar credit against all your Indiana liability. This amount here will show up on Schedule 5, line 1 of your Indiana return. Again, dollar for dollar. So if you have $3,000 on box 17 of your W-2, and that's your only source of income, then you should probably see $3,000 on Schedule 5, line 1. If you're married and you're filing jointly, then add your spouses as well. So, pretty simple. So what happens if we do Indiana County? Indiana County technically has two boxes, 19 and 20. 19 represents the dollars that was withheld for that specific county or locality, municipality, whatever. And 20 is kind of the description of what county it is. Now, what you may notice is there may be actually multiple lines for county, and that's not unheard of. So if you see multiple lines, don't worry. So for example, let's say your main office is in one county, but you have a satellite office in another where you have to go to, or you're a contractor and you have to do work across, say, southern Indiana or wherever. You may actually very well have multiple Indiana counties in 19 and 20, so multiple rows. If that's the case, just sum them up. Just add them all together, then you're good. But same situation that we just saw here. What you're going to do is you're going to take the amounts in line, or box 19, that's associated with Indiana, and you're just going to add them together. For this situation, let's just say it's $1,500. Generally speaking, not always, but generally, box 19 that's associated with Indiana will generally always be less than what was implicated to the state. Because again, state usually gets about 3.25%, county, depending where you live, about 1.5% to 2%. So again, in this situation, we're going to do half just for education's sakes. Now, again, since it's an Indiana withholding of this $1,500, you're going to get a dollar for dollar benefit. So again, if this is your only source of income, then you're going to take the $1,500. If you have a spouse, you want to look at their W-2 or whatever and add up all the Indiana local withholdings. In this case, it's $1,500, and this is actually going to show up on Schedule 5, line 2. Now again, if you're an Indiana resident and you have withheld Indiana state and Indiana local, again, it's simple. You just add these together and you get a dollar for dollar benefit against your Indiana tax obligation. So in this situation, we have 2 credits of totaling $4,500. Now let's assume there's no other credits and our Indiana obligation was, say, $5,000. So we owe $5,000 to Indiana. We have $4,500 worth of credits. So in the end, after I do my return, I owe $500. Likewise, flip it. If my Indiana obligation was only $400 and my credits total $4,500, ka-ching, $500 refund. Again, assuming no other credits and deductions and all that is withheld. Again, keeping it simple. Now let's get into a little bit of uncharted territory, which again is a pretty big situation depending on how you want to look at it and what you need to look out for. Again, you live in Indiana, but you work in Kentucky, you get your W-2 or whatever income form you have, and you look at your state withholdings and you see something for Kentucky. So what happens if you have Kentucky state in box 17? Now, what's nice is Indiana and Kentucky have this thing called reciprocity, which sounds nice, but it's often misunderstood. Basically, Indiana and Kentucky recognizes each other's state's income that's taxed, but not at the same time. So what I mean by this is you really just can't take this $3,500 that was labeled Kentucky and throw it as if it was Indiana. So this $3,500 example here won't show up on Schedule 5, line 1. Instead, you have to file what is known as a Kentucky non-resident return of a reciprocity state. Say that 10 times fast. So I had to completely cut the video because I completely forgot what the form was called. So this here, even though it's a long string of words, the form you want to fill out is a 740- NP-R. So it's an Kentucky state tax return for a non-resident of a reciprocity state. Now, this is where it gets a little tricky because generally speaking, you're going to get all $3,500 back. I want to strictly say generally because I've only done several handfuls of these, so I wouldn't consider myself an expert. So there may be a situation where you don't get the full $3,500 back, but I have yet to see it. So I'm just going to say generally. Generally, if again, whatever is in box 17 that's labeled for Kentucky, and if you're an Indiana resident and you file 740-NP-R, you're going to get generally all that money back. Now that may sound nice, but there's a pretty big problem with that. it takes probably 6+ weeks to get your refund, no matter where you follow it with, whether it's paper or electronically. So even though you're getting this $3,500 back, it's gonna be a while before you see it. The problem is, what may have happened is that $3,500 should have gone to Indiana, obviously. So you've already filed your Indiana taxes, but there's still state income that you did not pay because it went to Kentucky and not Indiana. So what happens is, now probably you owe Indiana something while you're getting money from Kentucky. So essentially now you're just middleman. You're waiting for your money. You're waiting for Kentucky to give you money that you paid them from state withholdings, and you're going to take that money and then you're going to turn around and pay Indiana. Generally speaking, the situation is Kentucky's probably going to take you 6+ weeks to get it, and Indiana now wants their money. And since you've probably underpaid since it went to Kentucky, they're probably already imposing some sort of penalties and interest on you. So even though this $3,500 could have gone straight to Indiana, and that would have been the end of it, you now have to wait for it. And let's just say hypothetically it was $3,500 we were short in Indiana. Now it's technically $3,500 plus possible penalties and interest. So in the end, you're really not coming out ahead if you have state tax or in Kentucky state taxes taken out, because you are probably underpaying Indiana. Now, I digress, because there was a situation I've seen before where someone got their W-2, they had an amount for Indiana state, in this case, let's say $3,000. They also had an amount for $3,500 to Kentucky. That's great. They probably don't have to owe anything to Indiana because there's already some portion that went to them. But now you have to wait 6+ weeks to even get your money back. So in the end, this potential situation, this client actually had more money taken out of their paychecks than they really needed. So they were almost double paying states, which was not needed at all. So in the end, they had to wait pretty much a full year to accumulate the $3,500 plus an additional 6+ weeks to get the refund. Not something you really want to do, because in the end, if you're paid, let's say bi-weekly, your paychecks could have gone up by whatever $3,500 divided by 26 is. 100 some odd bucks, I guess. So again, that's what happens if you have Kentucky state. You have to file a non-resident of a reciprocity form. Again, it's really simple. I think it's only one page, again, at the time of this recording. Generally, you get it all back, but again, there is a delay, and depending if you paid only Kentucky state, Indiana's going to be wanting their money sooner, and there's when interest gets in. Now, here's where it gets real tricky. You're an Indiana resident. Now you have Kentucky local taxes taken out. Again, same situation you'd probably see in Indiana. You may have multiple rows for Kentucky. You may have one for Louisville, another one for Louisville Metro, one for St. Matthews, Shively, I don't know. You probably will have certain other roles for Kentucky, excuse me. Same situation, you want to see what all is tied to Kentucky in box 15 and add them together. For this situation, let's just say it's $1,000. The problem is, we may or may not actually get a full dollar for dollar credit against this. This is where we may actually lose money. And more often than not, I do see people lose money. And it's not a fun conversation to have. So again, let's say you had $1,000 withheld from your paychecks, and you are trying to, okay, I'm digressing here. So again, you have $1,000 withheld from your paychecks that went to Kentucky local taxes. Again, you may not actually get the full $1,000 benefit. So what do we have to do here? Well, we have to look at Schedule 6, line 1 of your Indiana tax return. Now, this is where it's going to get a little tricky. The actual amount that you're going to get here is dependent on 3 things. So again, there's 3 things we're going to look for. The first is how much actually got withheld, which is the easy one. The numbers is given to you. And again, it's going to be box 19, that is going to be associated with the Kentucky. So add them together, and that's one of the numbers we're going to have to compare. So now you have one number. The other number is what was the Kentucky state income that was taxed times the county rate that you live in. So what you'll have to do with this is look at box, I guess it's 6. Whoa, now stop. Trey from the future here. When we were actually wrapping up this video, we noticed a mistake that the rest of the video is going to be talking about. So I need to come and interject and fix this. I'm talking that it's box 16 that you take times your county rate. Box 16 represents the amount of your Kentucky wages eligible to be taxed for state purposes, not county. So it's not box 16 you want, it's box 18. So it's box 18 that's associated with Kentucky times your county rate, not 16. Oops, sorry about that. The rest of the video I'm probably going to be 16. So look at box 16 of your state, of your W-2. Again, make sure it's for Kentucky. There should be an amount that's pretty close to your salary or whatever's in box 1 of your W-2. May not be exact, that's fine, but it should be more than likely somewhat close. Look at box 16 and times it by your county rate that you live in. Again, if you live in Clark County, it's 2%. If it's Harrison County, 1%. Again, just look at what county you live in Indiana and take it times box 16 of your W-2 or whatever income form you have. And that should give you some number. Not least, what you want to do is look at line 9 of your Indiana tax return, which is your IT-40. What line 9 represents is the actual tax obligation you have for Indiana County. So in order to get an accurate number for this, you probably will have to have your federal income tax, your 1040, completed, because that's going to roll into your Indiana return. And all of your Indiana deductions that arrive to this number have to already be taken into account. So this number here is not something that's going to have you're not going to have it with the snap of a finger. You will have to have it pretty much your Indiana return finished before you even know what this is. So again, this is probably one of your last steps. So what you're going to do is you're going to look at these 3 numbers. Again, the first thing you're going to look at is how much was actually taken out for Kentucky local taxes, the sum of them. You're going to compare it to the Kentucky state income that was taxed by Kentucky, but you're going to take it times your county rate for Indiana, which you should find on form CT40 of your Indiana return. Take them, multiply them against each other, and you're going to get another number. Last but not least, when your Indiana return is practically done, look at line number 9, which is going to be your county tax obligation. Look at those 3 together, and whichever the least of those 3 is, that is the amount of your credit, which is going to show up again on Schedule 6, line 1. Now, as you can see, logically speaking, if this is $1,000 that was actually withheld for Kentucky local on your pay, you're comparing it to 2 other numbers, and if those numbers are lower, then you're not going to get the full $1,000 benefit. So let's say hypothetically, the lowest number was $800. So $800 will transfer to Schedule 6 of your Indiana return, line 1, even though you actually paid out $1,000. So you paid out $1,000, but you're only getting benefit for $800. And technically speaking, more often than not, one of these 2 other numbers compared to this is going to be lower. So there is a situation where you probably will be losing out on money. Congratulations, we are completely done with our taxes, and our taxes have been filed and we're good to go. But now you're losing sleep because, again, you're an Indiana resident and you're either having to wait for your Kentucky state that was withheld, or you're going to have to realize that, again, everything that you paid into Kentucky local wasn't coming back to you. It wasn't as just simple as what we learned early in this video, when it could have just all been Indiana, and we would have just taken those numbers and just applied them straight to the Schedule 5 and called it a day. So what do we do at this point? What you'll want to do is get with either your HR or payroll department and ask for a form 42A809. Again, 42A809. Why can't they just make it easier? What you want to do with that form is ask to fill it out. It's pretty simple, generally 1 page. And what it says is, I hereby say that I live in a reciprocity state, in this case, Indiana, and you are going to be hopefully exempt from withholding both Kentucky and Kentucky local taxes. What this means is they'll hopefully be able to switch in their payroll system anything that would have been designated Kentucky state to Indiana state, or vice versa, Kentucky local to Indiana local. Now, one thing I do want to say, and I cannot verify this, but I have been told before that if your employer is incorporated in Kentucky, there may be some state or local taxes that cannot be exempted. I don't know if that's true or not. I've heard both ways. When I've told people to go ahead and get this form, I've heard more success stories than not, so I really don't know. But take it with a grain of salt, talk to your payroll, talk to your HR person, say, hey, I'm being charged Kentucky state or Kentucky local taxes. Stop it. I want Indiana taken out, not Kentucky. I want to get my tax forms done right, and I want to make sure that I'm not overpaying. So in the end, I hope all this has made sense. I hope you take it to heart. I hope, more importantly, you don't overpay taxes more than you have to. If there are questions, feel free to reach me out at treytarman@outlook.com. And happy tax filing. Thank you.